Welcome back to the channel. My name is Derek Coffey and I'm the founder of FWP. And along your investing journey, you are going to want to change the assets that you're exposed to. When you're younger, being in stocks is perfectly fine, especially if it's just you. If there's no one else to worry about, then stocks and the volatility that come with those stocks is perfectly fine. But as you get older and you start introducing more and more responsibilities to your life, you're going to want to find a way to even out that volatility. That's the importance of asset allocation. In this video, we're going to get into the asset allocations that I think are optimal for each age range, and then show you how it's going to factor in to your financial plan. Stay tuned. Now, before we get into the specifics of these asset allocations, I want you to keep in mind that this video is meant for educational and informational purposes only. Before you make any investment-related changes, I want you to run it by a licensed professional first. The last thing I would want you to do is to take this video as that professional advice, because it's not. Now, when it comes to investing and asset allocation specifically, there are two types of assets that we typically use. The first one of which is stocks. The second is bonds. Now, there is more to investing than just stocks and bonds, but during the accumulation phase of your investing journey, this is really all you need. Now, stocks specifically, since 2004 and the S&P more specifically, has returned just over 10% over that 20-year time frame. Now, along those 20 years, there is a lot of ups and downs, which we'll actually see on a graph in a second. Over that same time frame, bonds have returned just over 3%. With the bonds, they're much less volatile. There's much less risk involved than being invested in stocks, but the trade-off there is the returns aren't that great. So over that 20-year time frame, you can see, which the dark blue line represents the S&P 500, you can see just how volatile those stocks can be. January 31st of 2009. You would have lost a significant amount of money because of the Great Recession. But then after that happened, things started looking up again. And all the while, you see the constant ups and downs. Now, the difference here is the green line, which are the bonds. That is your stability. That is your diversification tool in your portfolio. The goal of asset allocation is to find something in the middle. Now, it could be a 50-50, which that's the light gray line that you see on this graph, but it could also be an 80-20 or a 70-30 or a 60-40. There are many different options when it comes to allocating what your money is invested in. The goal is to keep your returns as high as you possibly can while also providing yourself as much protection as you possibly can. The ups and downs or the volatility that we saw in that graph is the stress of investing. When you're younger, you can handle a lot of volatility because it's just you that you have to worry about. You could lose 20% one year, pick up 25% the next, and not lose any sleep about it. But as you get older and you start adding on responsibilities like a spouse or some children or even getting close to retirement, the volatility and the stress that comes with it just isn't worth it anymore. The easiest way to handle that volatility is to start diversifying your risk. If you're 100% in stocks, you're going to have to deal with those severe ups and downs. But if you can find other asset classes to allocate your money to, you can start to smooth that out. When it comes to diversification, the easiest way to do it is to invest your age in bonds. And this is nothing new. This is nothing revolutionary. This has been around forever. But it is the easiest way for you to think about diversification. In your 20s, put 20% of your portfolio in bonds. In your 30s, put in 30%, and continue doing this until you hit 50%. Now, the reason that I don't go beyond 50% is because if you're relying on your invested assets to produce income, you're going to need to have some level of exposure to stocks. You're going to need that growth to keep up with inflation. Now, if you're in your mid-80s or your early 90s, then yeah, 50% in stocks probably isn't necessary anymore. And this is also true if you have a significant amount of guaranteed income from Social Security and maybe a pension. But if you are relying strictly on those invested assets to produce your income, I would urge you to not go below that 50% stock threshold. Now, you may be wondering, what do these portfolios actually return, at least historically? Well, If we lay out the 50/50 portfolio since 2004, it's returned on average 7.1%. The worst drawdown that it has experienced over that 20-year time frame was from November of 2007 to February of 2009, where it lost just over 25%. Now, the thing about that 50/50 mix is that the time to recovery, or getting back to even, was much shorter than if you had more of your money invested in stocks. The 50/50 portfolio specifically was able to recover by April of 2010. Now, if we compare all of that data to the 60/40, the 60/40's returned 7.8%, a little bit better than the 50/50, but that's because you have more of your assets in stocks. The worst drawdown was over the same time frame, November of '07 to February of '09, where it lost almost 31%. The time to recovery for that portfolio was December of 2010, so an additional 8 months beyond the 50/50 portfolio. The 70/30 portfolio, 8.5% over those 20 years. That big drawdown during the Great Recession was 36.14%, and then it was able to recover by January of 2001. The 80/20, being the most volatile of the four that we're going over in this video, has returned 9.2% over the last 20 years, but during that drawdown period, it lost over 41%. Again, if you're young, you can handle this, but if you're getting older or you're getting closer to retirement, this is probably not something you want to deal with, especially if you retired at the beginning of 2009. The 80/20 portfolio was able to recover by April of 2011. This is a year more than what it took the 50/50 portfolio to recover. So when you're investing, you need to keep these things in mind. As you divvy up your assets, you need to understand what you're investing in, because when things like this happen, you want to be able to stay the course. The only way to do that is to understand where your money is and what exactly it is invested in. So now that we understand how those portfolios have performed in the past, we can take that information and apply it to different scenarios. So the first scenario we're going to go over is you're 20 years old. You're just getting started. You're making $40,000 a year. You're going to get a 3% raise every year. And you're participating in your company 401k, where if you contribute 5%, they give you 5% as well. From the age of 20 to the age of 29, you're going to be invested in that 80/20 portfolio, and we're going to assume that you receive that 9.2%. If that's the case, by the time you turn 30, you're going to have $75,000 in your account. But once you turn 30, we're going to switch it to the 70% stocks, 30% bonds, applying that 8.5% rate of return with the continued 5% contributions and the match. By the time you hit 40, you're going to have $265,000 in your account. We're going to do the same thing. We're going to move 40% of the money into bonds at that 7.8% rate of return. At age 50, you have $681,000. And then at age 50, we dial it back to the 50/50 split, or the 7.1%. And by the time you hit 65, you have just shy of $2.4 million in your 401k. All you had to do was contribute the 5% to get the match and follow that diversification rule, and you had almost $2.5 million saved. Now, if you're age 30 and you're starting 10 years later, let's assume you've gotten some raises. You're making $65,000 a year, the same 3% raise and the same 5% dollar for dollar match from your company. Getting started at age 30, you're in the 70/30 portfolio, getting the 8.5%. At age 40, you have $116,834 in your 401k. We're going to readjust that asset allocation to the 60/40, get the 7.8%, and at age 50, you have just under $400,000. At age 50, we go to the 50/50 portfolio until age 65, and you have $1.6 million in that 401k. Now, if you're concerned about not having maybe $2 million in that 401k, you can tinker with your contributions a little bit. If we change your contributions to 8%, that's going to get you over that $2 million hump, but it's only costing you 3 additional percent of your salary. Now, the other option is you could keep more risk in your portfolio, but if it's not something you can handle, if you can't handle the stress of being invested more in stocks, then I would urge you to consider saving more versus taking on that additional risk. If you decide to start at age 40, we'll assume you're making $70,000 a year. Everything else is the same. That first year, you're investing in the 60/40 portfolio. You're getting 7.8%. At age 50, you have $121,000. We make the switch to the 50/50 portfolio, and then by the time you turn 65, you have $705,000 in your account. Now, if we want to get that to the $1 million threshold, we do need to make some adjustments to the contributions. If we take it up to 10%, still getting the 5% match, it gets you just over $1 million. But still, you only have to put aside 10%. If we decide to wait until age 50 to start saving, then we'll assume that you receive some raises and that you're making $75,000 a year. You're still eligible for that 5% dollar for dollar, and you're going to get 3% each year going forward as a raise. Going right into a 50/50 portfolio is going to get you to just shy of $273,000 by the time you hit 65. Now, if this isn't going to be enough, you could increase the risk in your portfolio. You could go to a 60/40. You could go to a 70/30 if you wanted to. But the closer you get to retirement, the more important it's going to be to protect your assets because you're going to be relying on them to produce the income that you need. Now, if $273,000 isn't going to be enough, you can increase your savings. You can go to 10% and get you to $400,000. You could go to 15% and get you to $545,000. But when you're this close to retirement, I really want you to focus on saving more as opposed to increasing the risk that you're going to expose yourself to. Now, I want you to keep in mind that this is a very simple explanation of how asset allocation works. Your specific situation is going to determine exactly how you need to invest your money. If you can tolerate more volatility and the stress that comes with it, then absolutely you can put more of your money in stocks than just putting your age in bonds. But if you're very sensitive to what your invested accounts do on a day-to-day basis or a month-to-month basis, then I would urge you to consider diversifying some of that risk. The whole point of asset allocations is to keep your investing simple. If you can understand what you're invested in and what you can expect to experience when the markets go bad, you're going to stick to the plan that you have in place. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you're getting close to retirement and you're thinking about what would gold or utilities or even real estate look like in your portfolio to get you through your golden years, check out this video right here. But I thank you so much for tuning in. I'll talk to you soon.